Hey everyone, welcome to second part of this video where we are discussing stocks that have corrected from the peak, but domestic institutional investors are showing strong confidence and consistently accumulating stakes. In the first part, we discussed two pharma and one specialty chemical company. In this video, we'll cover two financials and one FMCG company. So if you have not watched the first part, do check it out. Link I'll provide in the pinned comment. Okay, one quick disclaimer before we begin. This is not a stock recommendation. If you're here just for stock names, please don't watch the video. Because at the end of the day, if you're investing your money in stock market, you must take ownership of your decision. Also, the purpose of the series is to understand the thought process behind DI buying, not to blindly copy institutional investors. We'll try to understand what went wrong with the company, why the stock corrected, and why institutions are still increasing their stake. If you find any of the company promising, you can deep dive further to build conviction before investing. By the way, all three companies are part of my tracking list where I closely track nearly 200 companies with all the development including quarterly results. Since we are already in Q1 result season, I'll continue to track them closely. If you're someone who does not get enough time to research and need help in keeping close eye on market to identify right investment opportunities, you can explore my weekly video series via join button of this channel or my website. Link would be in the pinned comment. Alright, let's get started. So first stock in the list is Equitas Small Finance. It started as a microfinance institution before converting into a small finance bank. Although over the years, it diversified aggressively into secured products like your small business loan, affordable housing, used commercial vehicle and loan against property. But microfinance still remained an important profitability driver because it earned much higher yield than secured lending. However, in FY25, Indian microfinance industry went through one of the worst stress cycle. As a result, all microfinance companies corrected significantly and Equitas also got impacted. Its earning tanked around 80%. As a result, its stock price tanked more than 50%. However, during this phase, DIs kept on accumulating Equitas from 42.6% to 50.8%. And weak hand of public have reduced from 41.9 to 34.3%. During this phase, number of shareholders have also reduced significantly. Interestingly, ace investor Ashish Dhawan has also consistently increased his stake in the company. Now the question is, why DIs and Ashish Dhawan have been increasing stake in Equitas in spite of such weak performance? The answer lies in two things. First is the management approach. Rather than postponing the pain, management chose to recognize the stress early through higher provisioning. Management said that they wanted to clean the book once instead of dragging the problem for several years. And the second reason is recovery in microfinance cycle. After a long period of pain, the microfinance cycle seems to be back on track. And Q4 FY26 was probably the first quarter where investors got evidence that the cleanup phase was largely complete. This slide gives a clear picture of pain and recovery. In Q1 FY26, banks' credit cost shot up to 6.5%. Return on asset fell to minus 1.68% and return on equity dropped to minus 15%. It was largely due to higher provisions taken to clean up the loan book. Now look at what happened over the next 3 quarters. Credit cost declined consistently to just 1.1% by Q4 FY26. This is probably the biggest indicator that fresh stress in the loan book has reduced significantly and the worst of the microfinance cycle is behind the company. As asset quality improved, gross NPA also started falling from 2.89 to 2.49%, while net NPA reduced even faster from 0.98 to just 0.68%. Another interesting trend is net interest margin. It recovered sharply from 6.29% to 7.29%, showing that earning power is beginning to normalize. All of this eventually reflected in the bottom line. Return on asset that has collapsed to minus 1.68 recovered steadily every quarter to 1.46% by Q4 FY26. Similarly, return on equity bounced back from minus 15 to now 14% in just 3 quarters. So if you pull all these numbers together, the story becomes quite clear. Asset quality is improving, provisioning requirements are falling, margins are recovering, funding costs are reducing, and profitability has normalized. These are exactly the signs you would expect from a bank that comes out of a difficult credit cycle. And that is why, despite sharp correction in stock over the last year, institutional investors have once again started taking a constructive view on Equitas. Looking ahead, management believes FY27 will mark the return to normal growth. They are targeting over 20% loan growth. At the same time, they intend to keep the microfinance portfolio at around 10% of total advances, significantly lower than historical average. making the bank less dependent on this volatile segment. Overall, management is guiding for an exit ROA of around 1.5% by Q4 FY27 with a full year ROA of approximately 1.2%. Please note that Equitas FY26 ROA was just 0.19%. Since banks are highly leveraged business, even a small improvement in ROA translates into a disproportionately large increase in profit. So FY27 should see sharp recovery in profitability. Company stock prices also recovered significantly from the lows and now trading near 52-week high, although it is still significantly below its all-time high level. But valuation-wise, its price to book is just half of its peak valuation. So on one side, while earnings are expected to recover sharply in FY27, on another side, the valuations are still very comfortable for Equitas. Second stock in the list is Mrs. Bector Food. It is India's one of leading premium packaged food company where it operates through two key brands. First is Cremica that sell premium biscuit, cookies and crackers, and English Oven, which is one of country's largest premium bread brand. Company also supply buns, bread and bakery product to leading QSR chains like McD, Burger King, KFC and Subway. In last 2 years, company's earning growth has kind of remained muted. However, look at the fall in stock price. It has tanked around 60% from peak. Yet DIs have consistently increased stake in the company in last 5 quarters from 19.7 to now at 25%. The question is, why Mrs. Bector share price has tanked 60%? Was there a problem with business or did expectations simply become too high? And why DIs are consistently accumulating stake in the company? So broadly, there are two key reasons for sharp correction. First is slowdown in growth. Company's revenue that grew at much faster rate in 23 and 24 slowed down in 25 and 26. More importantly, company's margin has fallen from 15% to 13%. As a result, company's profit growth has remained flat. Now there are two key reasons behind fall in margin. First reason is increase in raw material prices like edible oils and packaging material. And second reason is elevated employee cost and capacity expansion. So Mrs. Bector has been in an aggressive expansion mode, commissioning large-scale plant in Kolkata and Khopoli to scale up their English Oven bakery footprint. So this has impacted company's margin in the short term. Then second reason behind correction is expansive valuation. Between 22 to 25, company witnessed massive growth in share price that made the valuation expensive. So when the earning growth slowed down, stock got derated and hence corrected sharply. Now the question is, why DIs are buying it? In fact, recently on 15 July, a Bector's investment led by Sunil Singhania has purchased nearly 30 lakh shares at 169 rupee. So first reason is massive capex unlocking. As per latest data, company's Kolkata and Maharashtra plant have been commissioned in Q4 FY26. So these plants are now operational, which result in high utilization and that should improve operating leverage over the next few years. In addition, Mrs. Bector continued to gain market share in premium biscuit and premium bread, where organized players are steadily replacing the unorganized market. Also, margins have most probably bottomed out from here. So from here, it would be interesting to see how much company can improve the margin. And finally, after 60% correction, valuations have become much more reasonable with price to sale at significantly lower level and so is EV to EBITDA. So considering all the development, it's worth keeping a close eye on Mrs. Bector Food. Then third stock in the list is Home First Finance. It primarily provides home loan to first-time home buyer in low and middle income segment with an average ticket size of around 15-20 lakh. Unlike traditional bank, Home First focuses on self-employed customer. That's a segment that remains underserved by the formal banking system. Now if you look at its share price in last 1 year, it corrected nearly 40% from the peak, although there is strong recovery from the lows. But overall, stock is still down from its peak level. Now DIs have been consistently accumulating Home First from last 10 quarter, from 10% to now at 27.5%. In fact, even FIs have consistently increased stake in Home First. Although promoters have been selling, but we have discussed it in the past as well, that Home First does not have individual promoter. Its promoter was a PE firm that invested years ago and now they are booking profit. But the entire stake sale has been absorbed by DIs and FIs. In fact, weak hand of public has consistently reduced in Home First. Now the question is, why Home First share price has corrected and why DIs and FIs are increasing stake in the company. So if you look at financial performance, its AUM has consistently grown nearly 3 times in last 4 years. Disbursement is up 170% during the same time period. Asset quality did fall slightly but overall well under control. And recently asset quality has improved in March 26. And look at the profit after tax. It has grown more than 3 times in last 4 years. Return ratios are also solid with latest pre-money ROE at 17.5%. So on every parameter, Home First financials looked solid. Then what was the reason for correction in last 1 year? Well, I could think of one reason: elevated valuation. Its price to book was at more than 5. And now after the correction and consolidation, its price to book is much better level at around 3. Also the fact that affordable housing opportunity in India remains massive. Home ownership is still underpenetrated and government policies continue to support affordable housing. More importantly, Home First has consistently demonstrated disciplined execution. Management has also guided that they are comfortable sustaining 20% plus AUM growth over medium term while maintaining stable margin and asset quality. They are expanding branch presence, investing in technology and increasing productivity, all without compromising underwriting standard. So correction in Home First wasn't driven by deteriorating fundamental, but by a de-rating of an expensive stock. Domestic institutional investors appear to believe that if the company continued to compound earning at over 20% with strong asset quality, then today's valuation offer a much better risk reward than it did at the peak. That's probably the reason why they've continued accumulating the stock despite correction. So what can we learn from these three companies? The biggest takeaway is that stock prices and business performance does not always move together. Sometimes a stock falls because of a temporary business cycle, as we saw in Equitas. Sometimes the business continue to do well, but the stock corrects because valuation has become too expensive, as we have seen in case of Home First and Mrs. Bector. This is exactly where institutional investors often think differently. Instead of reacting to the latest quarter or the recent price movement, they try to understand whether the underlying issue is temporary or structural. If they believe the long-term earning power of the business remain intact, a correction can actually become an opportunity to accumulate. Having said that, DI buying alone should not be the reason to invest. Institutional investors can also be wrong and they can have much longer investment horizon than majority of retail investor. So you need patience. So use their buying activity as a starting point for research, not as your final investment decision. Okay, let me not stress this video. If you find it useful, do share it within your circle. And if you'd like me to cover more companies where DIs have been accumulating despite sharp correction, let me know in the comments. I'll see you next video. Till then, take care.